Good day, everyone. Today we're going to discuss the Chapter 8, Risk and Rates of Return. And we are the Group 8 and I am the first reporter. So, at the end of this chapter, we should be able to do the following. Explain the difference between standalone risk and risk in portfolio context. Describe how risk aversion affects a stock's required rate of return. Discuss the difference between diversifiable risk and market risk. And explain how each type of risk affects well-diversified investors. Describe what the CAPM is and illustrate how it can be used to estimate the stock's required rate of return. Then discuss how changes in the general stock and bond markets could lead to the changes in the required rate of return on a firm's stock. Then discuss how changes in a firm's operations might lead to changes in the required rate of return of the firm's stock. So first, we have the risk-return trade-off. We have here the figure 8.1. The trade-off between risk and return. So we have the panel A and panel B. In panel A, the individual investors' perspectives. Then the panel B, perspective of a company raising money to invest in risky projects. In panel A, we have the investment return and the investment risk. So good investment, the good investment, the return is sufficient to compensate for the perceived risk. And the bad investment, the return is insufficient to compensate for the perceived risk. Note that the slope of the risk-return line depends on the individual investors' willingness to take on risk. A steeper line indicates that the investor is more risk-averse. In panel B, the perspective of a company raising money to invest in risky project. We have the project return and the project risk. Good investment, the project return exceed the cost of capital. And the bad investment, the project return does not exceed the cost of capital. So note also that the slope of the cost of capital line depends on the willingness of the average investor in the market to take on risk. A steeper line indicates that the average investor is more risk averse. So, throughout the rest of this chapter, we discuss the simply ideas greater detail. So, later we discuss returns and we provide a model for estimating the trade-off between risk and return. Next, we have the standalone risk. Risk, the chance that some unfavorable event will occur. So, example, if you engage in skydiving, you are taking a chance with your life. Skydiving is risky. So, and also if you bet on the horses, you are risking your money. As we saw in previous chapters, individual and firms investment funds today with the expectation of receiving additional funds in the future. Bonds offer relatively low returns but with relatively little risk, and at least if you stick to the treasury and high-grade corporate bonds. Stocks offer the chance of higher returns but stocks are generally riskier than bonds. If you invest in speculative stock or any stock, you are taking significant risk in the hope of making appreciable return. An asset's risk can be analyzed in two ways. First is on a standalone basis where the asset is considered by itself, and the second one is on a portfolio basis where the asset is held as one of the number of assets in portfolio. Thus, an asset standalone risk is the risk an investor would face if he or she held only this one asset. Most financial assets and the stocks in particular are held in portfolios, but it's necessary to understand standalone risk to understand the risk in portfolio context. So, no investment should be undertaken unless the expected rate of return is high enough to compensate for the perceived risk. So, as we will see, the risk of an asset is different when the asset is held by itself versus when it is held as a part of group, so or portfolio of assets. We look at a standalone risk in this section and then portfolio risk in later section. So it's necessary to know something about standalone risk in order for us to understand portfolio risk. Also, a standalone risk is important to the owners of small businesses and our examination of physical assets in the capital budgeting chapters. For stock and most financial asset, though it is portfolio risk that is most important, still we need to understand the key elements of both types of risk. Next, the statistical measure of standalone risk. So we have the probability distributions, listing of possible outcomes or events with a probability or chance of occurrence assigned to each outcome, and the expected rate of return. The rate of return expected to be realized from an investment, the weighted average of the probability distribution of possible results. So here is table 8.1. Probability distributions and expected returns. So gives the probability distribution for Martin product, which makes engines for long-haul trucks, 18-wheelers, and for US Water, which supplies an essential product and thus has very stable sales and profit. So here there are three possible states of the economy are shown in column 1, and the probabilities of this outcome expressed as decimals rather than percentages are given in column 2 and then repeated in column 5. So there are 30% chance of strong economy and thus strong demand, and a 40% probability of a normal demand, and a 30% probability of weak demand. So in column 3 and 6, show the returns for the two companies under each state of the economy. Returns are relatively high when demand is strong and low when demand is weak. Notice also that the Martin rate of return could vary far more widely than US Waters. Indeed, there is a fairly high probability that Martin stock will suffer 60% of loss, and though at worst US Water should have a 5% return. So in column 4 and 7, show the products of the probabilities times that returns under the different demand levels. When we sum these products, we obtain the expected rate of return. So for each stock, both stocks have expected return of 10%, and we can graph the data in table 8.1 as shown in later in figure 8.2. The height of each bar indicates that the probability that a given outcome will occur. The range of the possible returns for Martin is from negative 60% to positive 80%, and the expected return is 10%. So the expected return for US Water is also 10%, but it is possible range and thus maximum loss is much narrower. So in this next figure, 8.2, we assume that only three economic states that could occur, the strong, normal, and weak. So suppose we had the time that patient to assign probability to each possible level of demand with the sum of probabilities still equaling 1, and to assign a rate of return to each stock for a level of demand. We would have a table similar to 8.1 except to the would have many more demand levels. So this table could be used to calculate expected rates of return as shown previously, and the probabilities and outcomes could be represented by continuous curve such as those shown in figure 8.3. Here, we change that assumption so that there is essentially no chance that Martin returns will be less than negative 60% or more than 80%, or that US Water's return will less than 5% or more than 15%. So the tighter or more peak the probability distributions, the more likely the actual outcome will be close to the expected value, and consequently, the less likely the actual return will end up for below the expected return. Thus, the tighter the probability distribution, the lower the risk. So next is measuring standalone risk, the standard deviation. Here, it is the formula of expected rate of return. So it is useful to measure for risk comparative purposes, but risk that can be defined and measured in several ways. A common definition satisfaction in the purpose is based on probability distribution, such as shown in this figure. So, the tighter the probability distribution of expected future returns, the smaller the risk of given investment. So we can use the standard deviation, or thus pronounced as sigma, to quantify the tightness of the probability distribution. The smaller the standard deviation, the tighter the probability distribution, and accordingly, the lower of the risk. We calculate the Martin sigma in table 8.2. We pick up column 1 and 2 and 3 from table 8.1. Then expected return, actual return, expected 10% return. The deviation are squared and shown in figure column 5, each squared and division. When multiply the relevant probability shown in column 6. So the standard deviation, or sigma, is measure of how far the actual return is likely to divide from the expected return. Martin's standard deviation is 54.22%, so its actual return is likely to be quite different from the expected 10%. US Waters standard deviation is 3.87%, so its actual return should be much closer to the expected return of 10%. The average publicly traded firm sigma has been in the range of 20 to 30% recent years, so Martin is more risky than most stocks in the US water risky. Here is the formula for standard deviation. That's all. Thank you.